So first question from David in Texas. Great question. You kind of hit on this, but it does expand upon the Apple vol discussion. It says, is volatility rising on price moves that are price moving higher just as concerning as volatility rising on price declines? He goes on to cite the Apple example.
Well, they can be in the very short term. You know, so that's the whole thing about something that goes up very quickly. It can come back very quickly. So again, that's the whole point that volatility through the lens of Apple is trying to tell you here. Don't be the pig. You know, in the last couple days of a parabolic move, this will be very typical for anybody who's traded for more than 2 years, never mind 20. Okay, so what happens is you get a vol spike because the standard deviation of outcomes of the price goes wider because the high end went up. You get that? You know what volatility is? Again, you start to measure and map the volatility of something. You're looking at its relative, or the standard deviations of outcomes relative to its prior self. So if its prior self is now 20% higher in a month, which is Apple, now all of a sudden people are like, whoa, well, where you were just a month ago, which is $370 a share, is a lot lower.
Totally.
You know, so that'll happen in a super short term. This happened in gold at the end of February and into March. It's happening to Apple now. It's not a good thing. Again, if it holds this level of volatility, it's a very bad thing. If the volatility comes all the way back, and don't forget that the risk range, you wouldn't know this because now you're asking me about something that you wouldn't have asked about unless I told you about it. But again, if you look at like Apple volatility is basically right now, it looks like it's 35 by 50, okay? So again, below 40, it's all good. Above 40, it's a problem. And again, that's a real good signal for you to be booking gains more aggressively. And if you're uncomfortable with that, then don't do it the way that we do.
Yeah, absolutely. You know, going back to your point on vol rising being not a great indicator, I mean, you just have to go back to the first 3 weeks in February, where the vol signal started to break out for the S&P and large and a lot of these large cap tech companies. And, you know, it was like, okay, the market's moving higher, but the vol is still gapping higher and risk ranges are widening. Yeah. And that was a clear indication that there was a lot of market risk developing underneath the price. So what you want is, you know, if you're a longer term bullish investor, to see episodic and non-trending volatility, like volatility to back off from this, you know, buying opportunity. If it doesn't back off, then that's clearly not, and you want to be risk managing that accordingly.
Let's unpack that again. So when Darius speaks, unlike most human beings, he's speaking mathematically. Okay, he's not garrulously ranting like Stephanie Link.
That's a good word.
So I mean, when you have A, like, so let's just say that one more time. So again, when you look at volatility, it's A, either let's say episodic and non-trending. Okay, non-trending, or it's starting to be, which is by definition it's episodic. It's episodic, starts to cluster, and becomes the new trend. Okay. Now that, I don't think that's stuff that they at Yale when he and I went there, they don't tell you about that. There was a squirrel hunter by the name of Benoit Mandelbrot who sat in the corner that used to talk about that. Right? The guy was like, you know how people go crazy when you see the world one way? Like the Earth isn't the center of the universe, like Newton or somebody, and all of a sudden everybody else is like, no, it's this way. Do you blame the guy for going crazy?
No, totally.
Asking for a friend. I mean, so again, watch. The most important thing to do in macro is to watch for this puppy right here. You never know when it's going to happen, but when it happens, okay, now we're paying attention. Now is it clustering and is it setting up? If Apple were to establish the low end of the range of 40 volatility, shit's going to go bad on a day when most people aren't ready for it, other than you. Okay? So pay attention. Again, pay attention to the particular. Don't have the arrogance to believe that you know how it's going to play out in full. Again, I said last week, I wrote this plainly. I explained the whole thing to you in an early look. Then I said, look, if everybody plays lucky, that can go on for a couple more days and I'll just stay there. Don't forget that I am, when I was breaking this down, I am long Apple. Like people are like, no, you're not. You just know your favorite pick. It's like, well, if you want a favorite pick from the Ponytail guys or the Kramer guys or whoever, but the other 5,000 people that have said that the Apple's the best company ever at this price, it's part of a main asset allocation. It's 20% or more of the ETF on the XLK. It's 14% of the NASDAQ. As of today, it's going to be over 8% of the S&P 500, or at least close to 8% of the S&P 500. It's embedded in our longs. And it's on the sheet, right? So obviously it's bullish trend. So again, it's something to pay very close attention to, in as much as we did in gold. You remember we had to risk manage that back in March when it first shot up and people got caught offside. There's actually a lot of vol to manage in gold today. Yeah, I mean, totally. Gold volatility at 25 is different than when gold volatility went to 15. That was the easy money in gold. Then all the monkeys came chasing the chart at $2,075 an ounce, and volatility went up. And now it's been a lot harder to make money on the long side of gold. And all of our new subscribers are like, wow, they nailed gold. aren't the same as our older subscribers. They're like, I've been long gold for a long, long time. Like, what's your deal?